Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by MarketFi. We have Gemma Godfrey on the line. She is a board director, broadcaster, and quantum physicist. She was also CNBC's first official contributor in Europe. She has been voted the most popular business influencer on social media and among the savviest on Wall Street by the Wall Street Journal. Gemma, how are you doing today?
Good, thank you, especially after such a great introduction.
Well, to start off, I would love to hear about your education, background as a quantum physicist, and how you came to work in the markets.
Well, I mean, it's very topical given that I went to go and watch the film Interstellar last night. So it just reminds me of the power of quantum physics. And it basically boils down to three things. First of all, it gave me an ability to break down the complicated into easier to understand messages. Secondly, there's practical applications. At its root, physics is all about solving problems. And thirdly, it's about thinking outside the box. And all three are so important when you look at the market, because you need to ask what's going on, what's really going on, why is it happening, and how can we do something about it? So if you can envisage something that's, both alive and dead and all these different quandaries that you have in quantum physics, that really helps you grapple with what's going on with the Fed, how's it going to affect markets, and looking, across the board and around the world for different opportunities and risk.
Okay, Jenna, I want to ask you about Japan. Now, they kind of shocked the market here a couple weeks ago, coming out with their round of QE, allowing institutions to invest more in stocks, and really gave a jolt to our, to the upside in our market. We really haven't given it back. They're also talking about, holding off on a tax increase. What do you think about the implications from the, Japan market, economy, and Fed on our market?
Well, it's interesting because investors did tend to brush this off. And the reason is that bad news at the moment is good news. The biggest threat that investors fear to global growth is policy missteps. So Japan is a prime example. What they did was they hiked their sales tax, and then this crushed consumer spending. But on the positive side to come out of that is that they're going to delay further tax rates. And when you ask whether you think it's a good idea or not, I think it's necessary, because, to use an analogy, it's necessary to put off a punishing exercise regime if the patient's dying. You're trying to revive the patient. So this is the reason why investors were very relieved. And ultimately, there's a difference between how slow a country will grow, so what's actually going on in the Japanese economy, and how profitable its companies will be. So what all this news flow really ignores is a structural improvement that we've seen in corporate Japan. Companies are showing improved earnings, better return on investments, they're paying a higher dividend, and this really hasn't been reflected in valuation. So what we're also seeing internally is the world's biggest pension fund, the Japanese pension funds, have doubled their weight to domestic equities. So really, they're backed internally as well. There is a substantial buy in the market. So this underpins our positive view on Japanese equities at the moment.
I guess instead of having the Bernanke or the Yellen put, we have the Japanese institution put under the market here, because that's a lot of sums of money and going into the market. So our economy is also, we're not independent, and things are going on in Europe, and the ECB. Those economies are kind of in shambles. Germany is really dragging their feet, maybe I should say, on
That's a good one.
Okay, you better not use that one without referring to me. But I guess in your words, is Draghi's bazooka back off the table? What are they going to do to revive the European economy?
So Europe at the moment, if you're an investor and you're deciding whether to invest or not, Europe is a binary trade, and it purely depends on whether you think that Draghi is going to pull out this bazooka. If he is going to we're going to see straight stimulus. So what we've seen so far is they do have an asset-backed purchase scheme going on, but this isn't straight government bonds. And the reason why there's this obstacle to straight QE is there's a big political hurdle. Because we're talking about multiple countries as opposed to, for example, in the US, it would be buying US treasuries. The concern is, how can a central bank buy, Italian sovereign bonds one day, Spanish the other? How does it differentiate? How does it choose? How can you have a central bank funding government? So what we need to see is that overcome, because ultimately investors have started to price this in. They've started to expect it because the economy is, we saw today the Eurozone recovery has slowed to a 16-month low. We saw German confidence start to revive. There's negligible growth there. France is struggling. These are the engines of Europe. So we have to ask ourselves two questions. First of all, how much is already priced in? And secondly, how high the pain threshold will be before the central bank comes out and does more. And, it is looking like it's under more and more pressure, which could really be a real big boost to the financial market. The way that we're looking at it is that we've heard plans, we haven't seen enough action yet. We're hearing about capital plans, but no hard cash. So we think we're trying to focus on investing in, international companies that, yes, they're based in Europe, but actually they're selling a lot of their products. You talk about being global. They sell a lot of their products outside of Europe and therefore slightly more insulated from anything going on domestically, but they're still very strong companies. They've still got strong balance sheets. They've still got, good cash flows. So we still have, significant holding to European equities.
Gemma, we've got a question coming out of the chat here. Moving back to Japan, with regards to the snap elections that they're going to be doing, I think about mid-December, what if the prime minister loses? What does it mean for his all-in fiscal monetary policy plan?
Well, what we're likely to see is still a continuation of certain policies that have been put into place. So I think that obviously investors don't like anything unpredictable, and also they don't like too much of change. It's like Goldilocks, a little bit of change, but not too much that it's something to become uncomfortable. And ultimately, nobody in power, wants to kind of shock the markets and also do anything too drastic. So what we would see is a continuation of trying to revive the economy, trying to revive inflation, and all of this would be positive for asset prices, and therefore would keep us constructive on the region. So we think that it was the right thing to do. We think it's a positive thing to do. It's giving people the chance to vote and to get consensus behind the people that are in power, and that's merely going to help boost things going forward.
Okay, so we're going to shift gears a little bit in here. Now, do you think there's a bubble in the technology sector right now? And if so, what would make it burst?
Oh, okay. So this is a very hot topic at the moment. And what I would say is this. There's no bubble, but there are pockets of overvaluation. And it's so important to differentiate between them. So what we're seeing is companies that have come to market, they've decided to list their shares, and there's been a lot of fanfare, there's been a lot of excitement. Ultimately, they've been overhyped. And the reason is because they haven't had any clear strategy on how they were going to profit. So we've seen quite a lot of pop and drop. So the shares will pop the first day because the shares, they were oversubscribed, etc. And then as soon as people took a closer look at it, or they started reporting or whatever, people started to get a bit more sensible, the shares would come off. So we'd say that's areas of overvaluation. However, there are many companies in the tech sector. It's one of our preferred sectors, is tech and healthcare. And the reason is that there are stable companies with strong balance sheets, a proven track record, and long-term plans. My big tip would be this. It's I'm sure you've heard the phrase before, but revenue is vanity, profit is sanity, cash flow is reality. And ultimately, if you look at the cash flow of these companies, you'll be more in a better position to separate the winners from the losers.
Okay, Todd, what a great answer on that. Talking about bubbles now, let's just shift to the bond market. And I guess it's not about who's right or wrong in bonds, but how big the blowout will be. Could you give us a little further commentary on that that comment?
No, exactly. What I was trying to allude to is it's like when you have an argument with your partner. Ultimately, it's not who's right or who's wrong, but actually how big is that argument going to be? And the reason why there's this analogy for the bond market is you've got a big discrepancy between how fast the investors believe that the government is going to be raising rates in the US and people in the Fed, their expectations. And so it doesn't matter who's right or wrong. What's ultimately going to happen is if there is such a discrepancy, things don't tend to correct calmly. They tend to overshoot. So what it means in terms of an investment perspective is that we're then cautious on anything with a high sensitivity to rate expectations. So, for example, government bonds, anything that's low yielding, etc. You call it a high, lower duration. So that's where we're positioned. We think that inflation ultimately, it is low, but we've got to be cautious of where rates are. We think that the US is going to keep rates lower for longer, but when they do start to raise rates, you may initially start to get a bit of a shock in the market.
Do you have any timetable for that? I mean, because to me, I know that's like
that's
the
$1 billion question.
Yeah, because I mean, it's just the way the Fed is acting in their current stance.
Yeah.
It just seems like, they've kind of backed themselves into a corner with this. So I guess that was kind of an unfair question. Got a question coming out of the chat here, and Ace, who's one of our top contributors, would like to know if you are a member of the Internal or the 999 Society.
Oh my gosh, what's that? I'm intrigued. I don't believe I am, but it sounds like maybe I should be. I don't know.
Well, Ace is he's one of our brainiacs here, and I guess it's for people with really high IQs, so you can understand why I'm not a member of them either. But
I'm very flattered.
Okay, that's just coming out of Ace, so that's a great answer. Okay, another question coming out of the chat: is the Bank of England still first in line to hike rates?
So it is more likely that the Bank of England's going to move first, just in terms of where inflation is, and therefore they've been ready and more aggressive. However, there is a similarity between the outlook for when the Bank of England and also when the Fed's going to raise rates. Both of them have been pushed out. So a lot of people were talking about the end of this year, for example, and obviously it's been pushed out to even, towards the latter end of next year, and some people are even saying, or in the US at least, 2016. So the outlook is similar. The Bank of England is in a better position in terms of where inflation is and where economic growth is, because the UK is leading. The OECD came out and said the UK is leading economic growth in the developed world. But it's a case of watching this space, and they both have the same challenges to grapple with, because ultimately they don't want to restrict. They don't want to restrict growth too early, and both governments, both central banks, are more likely to risk inflation rather than risk, deflation or falling back into recession. So they're more likely to delay than do anything too early.
Okay, one final question from you, and this is just kind of what I wanted to really ask you. Being a quantum physicist, obviously you've worked with a lot of complicated mathematical, situations and problems. Have you figured out anything in the markets from price or volume? Do you have anything from your mathematical background that you use as indicators in the market?
Well, I'll tell you what it's really taught me, my background, and I was proven, in 2008. It's to try and build the picture, as opposed to rely too much on one data point or one technical point, or looking in one asset class. Because ultimately, the people that foresaw the credit crisis and were well positioned were the ones that, even if they were managing, purely an equity portfolio, or they were managing, they were highly rated, they could see what was going on in the credit markets. And likewise, when it comes to technical indicators, yes, they are incredibly useful, but sometimes there's a discrepancy, and if you look at a second or third one, you'll be able to understand why actually that's when they become invalid, because the markets are changing so much, and there are all these other different dynamics that are driving them. So what I would actually advise is yes, look at all these indicators because they're very important, but actually try and build a picture instead of relying too heavily on one.
Okay, that great answer. Gemma Godfrey, broadcaster and quantum physicist, taking time out from her busy morning to be on our show. Thank you so much, Gemma. We hope to have you on again.
Oh, it was a pleasure. Thank you very much.